TEV, total enterprise value, really important number, and we're going to talk about why. But TEV, the simple calculation is market capitalization plus debt, and if that makes no sense, do not worry. We're going to try and understand what this means, and this is a very surprisingly simplified calculation. But in English, I suppose, total enterprise value is how much does it cost to buy the company, the business, that's the market capitalization, and what do they owe? That's their debt. And so what do they owe will sometimes include other things like dividends and preferred shares. But simplified, how much do they owe? And the general idea is we want to know how much this company is worth. And so, how much does it cost to buy it? Factors in what it's worth. But also, how much does it owe is because they're using that money to build and run the business. And so you want to kind of factor that in. And we'll talk about this quite a bit more. But that's the general sense. When you're looking at total enterprise value, you're kind of looking at what's the worth of the company to run it. And that'll involve both buying and understanding their debt. So where do you use TEV? Well, I have just a few off the top of my head. The worth of the company, comparing two different companies, and sometimes I've seen it used in analyzing risk. Okay, but let's take a step back, because like I said, this is a little bit confusing. So buying companies, it's possible no one ever does that, but at least hopefully everyone will at one point in their life, either themselves or know someone at the very least, buy a house. Now, how do we usually understand the value of a house? Well, it usually has to do with how our property is doing in the area around, but let's pretend somehow you're not allowed to know what this house is worth based off of any other houses around. That information, the government decides they don't want real estate agents using that information. They're going to hide it all. Okay, so one way of trying to figure out what a house is worth is, well, what did the guy spend on it before you that he spent money on it when he bought it. So let's say he spent $1 million. So for you, you might say, well, at the very least, it's worth $1 million. And then you find out, well, he had to take out a mortgage to buy the house of $500,000. So he didn't buy it outright. So it's $1.5 million is probably, at the very least, what the house is worth. And then you learn while he's lived there the past year, he actually put on an addition of $100,000. Okay, so now we're looking at $1.6 million. And so you can kind of see how we're trying to put together all these different pieces of information, all these different financial numbers to try and get an idea of how much something's worth. Is it a perfect number? No. Maybe housing shot up, maybe housing went down, maybe there's inflation, who knows? But we're trying to get just some form of an idea. Right? That's a very useful tool because otherwise, where do you start? And so you could kind of think of market cap as, the money that he spent on the house and the addition that he put in, and the debt is part of the mortgage. So look, we're looking at $1.6 million. But now let's pretend you find out that buying the house, you also get the contents of the house, and there is some cash. How much cash? $200,000. Okay, so that might, in theory, increase the price you actually have to pay for the house. But what is the house worth? Well, we said some of that debt is, part of the value of the house. He had to use that to buy the house. Well, maybe, the fact that there's $200,000 in cash, maybe some of that mortgage was actually turned into just cash. It wasn't actually spent on the house like you originally thought. And so really, maybe you'd subtract that from the debt. And once again, maybe this analogy is not perfect for total enterprise value because we're talking about a house, which does not really generate income. Well, I suppose it could, but different conversation, I suppose. But and a company, they're not quite the exact same thing. But nevertheless, we're trying to use it to get the idea. And so when we have this market cap and debt, I wanted to point out this idea that cash, or things that are usually turned into cash pretty quickly, are usually subtracted from total enterprise value. And that's because, like we said, debt is part of running the business. Well, if there's cash, you didn't need that debt. That debt is not so necessary for running the business. And so the cash kind of cancels that out. Something to remember. And that's why I said before, that equation before was a little bit simplified. But I wouldn't worry about that too much. Okay, so let's look at something still simple, but a little more practical, an online store. Market cap, there's 100 shares for this online store. They each cost $10 each. Once again, trying to keep the numbers simple. And so if you wanted to buy this online store, you would, in theory, have to pay $1,000. How much debt do they have? Nothing. Great. How much sales? They make $250 a year. However, it costs them to make those sales $150 a year. Maybe they have to pay an employee, for example. Depreciation and amortization, $50. Every year, their cash register, or I guess it's not an online store, so they don't have a cash register, but something, the server, the computer gets a little bit worse, and eventually they could have to buy a new computer, and so they're depreciating the computer each year by $50. Fine. And we'll have another video about depreciation and amortization. If it's at all confusing, let me know. And interest, well, there's no debt, so you don't have to pay anything on the interest. So at the end of the day, you had the $250 of sales. It costs $150, so you're left with $100 profit. But then there's the depreciation, and so they take that off, and you're left with $50 of income. Okay, so now if we wanted to know the total enterprise value, maybe hit pause, think about it. How do you calculate that? There's a lot of information here. Sometimes it can be confusing. That's how you get to look at a 10K. That's how you get to look at financial information. You get a lot of information, sometimes more than you need, at least for one number. So TEV, remember, is market capitalization plus debt. So this should be pretty straightforward. And here it's $1,000 to buy the shares, and there is no debt. So $1,000, like I said, a little bit of a straightforward case. Well, let's compare that now to a brick and mortar store. Once again, simple market cap. This time it's 70 shares, but they're each still $10. Great, $700 to buy this brick and mortar store. Except this one has debt of $300. Sales are the same. Cost of sales the same. Depreciation and amortization the same. Those three numbers are going to be the same. So we can kind of keep things comparable and make it a little bit easier for us. Now in terms of interest, well, now we have debt. 10% interest maybe. Really bad rate, but okay. $30 a year is lost to the debt. And so at the end of the day, your income is only $20. Not nearly as good as the last company. Okay, so if we wanted to calculate the TEV, so think about it, pause, think about it. Once again, should be straightforward if you just watched and paid attention to the previous video. If not, you go back and check. But it's equal to market cap plus debt, those first two lines here. So it's $700 plus $300, that's going to give you $1,000. That is the total enterprise value. Well, that's kind of interesting. So the brick and mortar store has a total enterprise value of $1,000. The online store also has $1,000. Except brick and mortar looks a little bit worse because it's only making income of $20 and online's making $50. Why? Well, because of the interest. Well, wait a second. Because that debt that we used to help calculate the TEV for $1,000, well, if I actually paid over $1,000, I would not be paying that interest anymore. And so, those would be they would get the same income, the $50. So there's a little bit of a mismatch going on, I suppose. And so that's why people use EBITDA, which is the earnings, pretty much the income in this case, and we'll add back, it's before the interest, tax, depreciation, and amortization. So we'll add back all of those things. So let's back up a second. So on the right-hand side, the online store has income of $50, no interest, but we'll add back the depreciation and amortization. That's $100. On the left, we have $20 income. We'll add back the interest. We'll add back the depreciation and amortization. And we haven't talked about taxes, so we'll ignore that for now. And so the EBITDA for both is $100. Okay, so we have the exact same total enterprise value, and their cash flow, the money coming through the company, the money the company can generate, is both $100 for the year. Okay, so that's pretty interesting. So now we're kind of thinking, maybe you think these aren't the same companies originally because one was making 50 and one was making 20, but now based off of the way we're looking at, they're actually the same. They're equal. Now you might say, no, they're really not equal because one costs $700, one costs $1,000, but no, they are equal because when you spend $1,000 on both, you'll get rid of that debt, you'll get rid of the interest, and so even if there's something niggling you at the back of your mind, oh, they're not the same, no, they are. Now, you might actually have an argument by one might in the future be better. Maybe the online store will continue getting more money and as it grows, do even better. That's a different question. Right now, though, the numbers are telling you, no, they're equal. And if you disagree with that, you have to think about why that ratio is wrong. Maybe it's not covering everything you want it to. And okay, so let's talk about this ratio, the total enterprise value divided by EBITDA. People call it TEV to EBITDA. Now, why is this so useful to use these types of ratios, right? That's really important to talk about. Well, it's just standardizing. You standardize a ratio, it gives you kind of like a measurement stick. So I can compare these two different businesses and I can see how do they compare? How do they line up in terms of me buying and how much money do they generate? That's a pretty simple idea. And so if I can compare that, I can compare tons and tons of businesses. In this case, they're both $1,000 over $100, and so they both have a ratio of 10. Now, when we're thinking about this ratio, if the cost of buying it, if the cost of operations goes up, the TEV, so will the ratio. That number will go up. If the cost of buying goes down, the ratio goes down. If the earnings go up in the denominator, the ratio goes down. So if you're making more money, that number gets smaller, that ratio number gets smaller, starting to look, hopefully to you, that you want a lower ratio, because if the earnings go down, that ratio, that number goes up. So 10 is actually a pretty good number. This will probably change depending on the financial situation of the world, how well are companies doing, how well are earnings going in general, things like that. And so I wouldn't say, 10 is perfect, anything under 10 is great. I'm sure that'll change. Maybe sometimes 14 will be great. I don't know. But this is very important, and it's very important to know what the general average is, but also what the sector is. So if you have a gold mining operation, that might have a very different ratio compared to some other operation, I don't know, power plants. So always good to look at the sector, and this is information that's really usually readily available. Okay, something else I want to talk about now, and that is TEV over EBITDA. $1,000, we calculated over $100, that was the earnings, and that's equal to 10. Great, but we kind of erased the depreciation here. So what was the depreciation? Do you remember? It was $50. Okay, well, let's just do something for a second. Let's look at TEV before earnings, TEV over earnings before interest and taxes. And we're not going to ignore the depreciation and amortization. We're going to actually pretend that you don't make that money. Okay, so now it's $1,000 over $50. Now the ratio is 20. Those numbers are really different. 10 to 20, that's a big difference. What does that tell you? Well, that pretty much tells you that this business, although there's a lot of money coming in when you look at the EBITDA, at the end of the day, when you factor in depreciation, it's not such a great company. What does that tell you? Well, depreciation, once again, remember, we're kind of subtracting from an investment we made, because eventually we're going to have to actually buy that investment again. We're going to have to eventually replace it. That's kind of what depreciation is. Like I said, we'll have to probably get other videos for these topics. But nevertheless, and if I have one, you'll see the card, I'm sure, I hope. But nevertheless, you see these numbers aren't equal. And so that's going to tell you depreciation is a major part of this business. Major purchases, major investments that depreciate are part of this business. And so that might be a red flag. I don't want to invest in a company like that. Or maybe you're okay with that. And maybe you think that there won't be so much depreciation in the future. The cost of the machinery is going down. Or maybe you don't mind. You have to think about that depending on the business, but it's just important to know these types of things. However, of course, if they're roughly the same, then depreciation, these major expenses are not a big deal. And that brings us to our next point, something that a lot of people do as well when they're using this ratio, and that is not just having TEV over EBITDA, but subtracting capital expenditures. Okay, once again, making it more confusing. Well, it's not so bad. What are capital expenditures? Well, capital expenditures are pretty much, did you buy a factory? Did you buy a machine? Did you buy some sort of asset that's for the company? And so pretty much what we're trying to figure out at the end of the day, keep in mind the intuition. We're trying to figure out when you buy this company, what you're going to be paying for is the cost of the company, the cost of its operations, divided by how much money does it generate? How much free cash flow is there? What money is coming in? And so yes, earnings before all these other things is a very useful thing. And we subtract capital expenditures because at the end of the day, the company technically bought a factory, it bought machinery. And so that's going to remove some of the money, some of the earnings, some of the cash flow that's coming into the company. And so, for example, a company that regularly buys machinery, well, you might be a little bit nervous about that company without, just ignoring the capital expenditures because the earnings are not really fair. You think you're making $100, you're really only making 50 maybe. However, if it's a one-time thing and it's already happened, maybe you're willing to ignore the capital expenditures. This is something you have to think about. But the general idea is when I have this company with this type of asset, with this, everything that's going on, and sometimes those capital expenditures will actually show up and make the TEV on the top a little bit larger. So, you have to think about some of these things, about how they affect. And that's why we want to try and build our intuition. Where do these numbers come from? Because at the end of the day, you'll probably be able to Google these things. You might have some software that already calculates them for you. But you might know some underlying fact about the company that might skew this calculation, might make you want to alter it. For example, they bought a factory. They won't have to buy this factory again for another 100 years. maybe the TEV over EBITDA minus capex, maybe that'll be a very large ratio, but next year it'll be a very small ratio or whatever it might be. So you might be willing to overlook that. These are the types of things you want to think about. And maybe, or for example, there's two companies and you're comparing them. One bought the factory this year, one bought the factory, either the next year or the previous year. And so maybe that's an unfair comparison at the moment. And so people use not just the TEV, not just this ratio over, right now, but they also use this ratio, historically, like where has this ratio been over the past year, 2, 3, 4, 5 years, comparing it with the other company. Is it getting better? Is it getting worse? Is this just an anomaly this year? Is there a spike? Why is there a spike? And so these ratios are not going to tell you everything. They're going to be, though, something that points you in the right direction. So, for example, let's say you find a company that has a horrible ratio. Well, you could sit in theory and think about, is there something that's causing, a spike this year? Historically, is it always bad? Okay, well, maybe I don't want to consider this company right now. And why that's useful is you will probably get rid of an enormous amount of bad companies that you're really not interested in because how much they cost, they're not giving you enough money, enough earnings. Now, you might get rid of some actually very good companies, even some growth companies, some companies that are growing and going to become more valuable in the future. So you have to be a little bit careful with this ratio. But what you're left with after you've kind of ignored, let's say, 90% of the bad companies, you might have 10% companies that they might not all be good, but you have a very small number of companies that you can analyze now and figure out the good ones from the bad ones. And so this is an easy way sometimes to filter, sift, sort. Like I said, this number's not going to tell you everything, and comparing companies in different sectors might be a little bit challenging, might be misleading, but nevertheless, these are the types of things, these are the types of ratios that make your life easier, and definitely only make your life easier once you really understand them. And that's kind of what I've tried to do. Kind of tried to brought the intuition here. And, I'm not a CPA, but this is the way I look at these numbers, look at these ratios, and that's the way I use them. Hopefully you found that useful. Let me know, comment, subscribe. Definitely let me know if you like these types of videos and I can make more informative videos and not just analysis videos.